If you have a bank account, and most people do, then I want your attention for a few minutes because there is a policy conversation happening right now that a lot of ordinary Americans are brushing off as boring, technical, and somebody else's problem. That is usually how expensive mistakes begin. When people hear a phrase like IRS bank reporting threshold, their eyes glaze over. They assume this is a story for lawyers, compliance officers, or people doing something crooked with money. It is not. It matters a great deal if you are retired on a fixed income. It matters if you handle cash regularly. It matters if you like your financial life private, orderly, and simple. And it matters especially if you are the kind of person who believes that because your money is clean. You never need to understand the rules around how it is watched. That is the kind of assumption I have spent my whole life trying to avoid. I do not like surprises when they involve capital government or human behavior. And when all three show up in the same room, I like surprises even less. So I want to walk through this calmly the way I would explain it to a friend sitting across from me at a table in Omaha. Not with drama, not with slogans, and not with the kind of nonsense that gets spread online whenever somebody wants to scare retirees into clicking a thumbnail. I want to explain what the $10,000 rule actually is. I want to explain what people get wrong about it. I want to explain what has been proposed beyond it. And I want to explain why so many seniors are paying attention even though, strictly speaking, nothing dramatic has changed yet, because that is where the real issue lives. It does not live in panic. It lives in understanding the difference between what exists, what has been proposed, what failed, what might come back, and what all of that means for somebody who is just trying to collect Social Security, manage an IRA, and move through retirement without inviting unnecessary trouble into their life. Let me start with the foundation, because almost every confused conversation on this topic begins with a misunderstanding of the rule itself. Under existing federal law, specifically the Bank Secrecy Act, banks are required to report cash transactions of $10,000 or more. Cash transactions, that distinction matters. If you walk into a bank with $12,000 in actual cash and deposit it, the bank files what is called a currency transaction report. It happens automatically. You do not need to request it. You do not need to sign a permission slip. You do not receive a friendly little note in the mail saying, by the way, we sent your transaction to the government. That simply happens in the background quietly, mechanically, as part of the compliance machinery built into the banking system. Now, the original purpose of that rule was not to bother ordinary people. It was to create a reporting trail for large cash movements that might indicate money laundering, drug trafficking, organized crime, or other financial misconduct on that level. Most people can see the logic. A government that never looks at large cash transactions at all would make life very easy for criminals. The trouble is that once a reporting system exists, it does not stay neatly contained inside the world of criminals. It spills outward, it touches ordinary people. And it touches them most often when they do not understand the rule well enough to recognize how their own behavior looks from the outside. That brings me to the second concept, and this is the one that catches more innocent people than it should. The word is structuring. Structuring means breaking up a larger transaction into smaller ones in order to avoid the reporting threshold. In plain English, if someone has $12,000 in cash and decides not to deposit it all at once because they want to stay under $10,000, so they do $4,000 today and $4,000 next week and $4,000 after that, they may think they are simply being careful. Federal law may view that very differently. Under the law, deliberately arranging transactions to avoid the reporting requirement can itself be illegal, even if the money is perfectly legitimate. That is the part a lot of people never hear until it is too late. They assume the law only cares whether the money is dirty, but the law also cares about whether you tried to avoid the reporting system. That is why this subject matters to ordinary people. Not because they are doing something wrong, because they may wander into suspicious looking behavior without understanding that the system judges patterns, not just intentions, and that is where retirees and small business owners sometimes get drawn into deeply unpleasant conversations even when there is no criminal purpose at all. A man sells a car for cash. A widow receives cash from a downsizing sale. A family helps an aging parent move money around after a death in the family. Somebody makes a series of deposits because they think smaller is safer. They are not trying to hide anything. But from the outside, the transaction pattern can look like avoidance. That is not a theoretical concern. That is part of the reason this old $10,000 rule still deserves attention after more than half a century. Now, if that were the whole story, I would tell you to understand the current rule, keep good records, behave straightforwardly, and move on with your day. But that is not the whole story. What has created fresh anxiety is not the $10,000 cash reporting rule by itself. It is the policy conversation about expanding reporting beyond large cash transactions into broader account activity. That is where the conversation moved in recent years. Back in 2021, the Treasury Department pushed a much broader idea. The proposal, in its early form, would have required banks to report information to the IRS on accounts with more than $600 in annual inflows or outflows. $600. That number was so low it did not feel like a tool for catching sophisticated tax evasion. It felt like a microscope pointed at ordinary life. One or two moderate transactions could put an account into the reporting system. A retiree paying regular bills, a grandparent helping a grandchild, a person receiving routine deposits, a small household emergency moving through a checking account. That is why the backlash came fast. Banks objected privacy, advocates objected. A great many ordinary Americans objected. They heard $600 and reasonably concluded that Washington was no longer talking about major hidden income streams. It was talking about looking through the windows of everyday financial life. The stated purpose, to be fair, was to narrow the tax gap, the difference between what people legally owe and what they actually pay. And the tax gap is not fiction. It is a real number. And by the government's own estimates, it runs into the hundreds of billions of dollars a year. Politicians hear that kind of number and start looking for data. That is what governments do. If there is a leak, they want a map. The problem is that when governments go looking for a leak, they often design a net wide enough to catch a great many fish that were never the target. That is what the public sensed in that $600 proposal. It did not feel surgical. It felt broad, blunt, and intrusive. So the original version did not survive. Later discussions raised the threshold dramatically, with one revised concept floating a $10,000 annual account activity number rather than $600. Still controversial, still broad, still a very different animal from the long-standing rule on a single $10,000 cash transaction. And that difference matters more than people realize. A currency transaction report is about a single large cash event. A broader account activity reporting regime is about the life of the account itself. That is a very different level of visibility. One is a guardrail, the other starts to look like a dashboard, and that is why the subject has not disappeared, even though the broadest versions did not become law. Policy ideas do not always die because the public hated them once. Sometimes they retreat, sometimes they get renamed, sometimes they reappear inside larger legislation with less fanfare than they attracted the first time. So when people ask whether some version of expanded bank reporting could come back in 2026, that is not paranoia, that is a sensible question. No one honest should tell you the answer is certain, but no one serious should tell you the conversation is imaginary either. Now let me get to the part that explains why seniors in particular are watching this issue more closely than younger people sometimes do. A lot of retirees have financial lives that are simple, predictable, and regular. That sounds like a virtue. And in many ways it is. Social Security arrives on schedule. A pension arrives on schedule. Required minimum distributions come on schedule. A few transfers happen during the year. A checking account becomes the central hallway through which everything passes. Nothing exotic, nothing aggressive, nothing hidden. Just the ordinary plumbing of retirement. Take a simple example. Suppose someone receives $1,800 a month in Social Security and $3,000 every quarter from an IRA distribution schedule. Over a year, that is roughly $33,600 moving through the account in a steady rhythm. Under the existing cash reporting rule, none of that automatically triggers a currency transaction report because there is no single cash transaction of $10,000 or more. But under a broader annual inflow or outflow reporting concept, that same account could easily become reportable. Now let me be very careful here, because this is where careless people sow confusion. Being reportable is not the same thing as being guilty of anything. It is not the same thing as being audited. It is not the same thing as owing a penalty. It simply means more information flows to the IRS. For many clean, straightforward taxpayers, that might never lead to any practical consequence. But retirees are not wrong to worry anyway. Why? Because privacy matters, because the feeling that your routine legal activity is flowing into a bigger federal reporting pipeline is itself uncomfortable. And because government systems are not operated by angels, they are operated by people, software, staffing levels, budget constraints, and human judgment. If millions of new accounts became part of a reporting stream, somebody has to process that information. Somebody has to set filters. Somebody has to decide what patterns deserve a closer look. And if that process is imperfect, as large bureaucratic processes usually are, the burden of sorting out the misunderstanding may fall on a 74-year-old retiree with fixed income, limited energy, and no appetite for wrestling with a federal inquiry over perfectly normal account activity. That is not hysteria. That is common sense. When a system expands, the probability of friction expands with it. And the people least equipped to enjoy friction are often the people living on routine, modest, lawful cash flow. This is why I always tell people to separate two questions. Question 1 is whether a proposal is aimed at criminals or tax cheats. Question 2 is whether the machinery built for that purpose may also touch decent people who simply happen to have visible, repetitive, or easily misread financial patterns. The answer to the first question may be noble. The answer to the second question may still be troublesome. Now, because this issue has been talked about online in a great cloud of exaggeration, I want to slow down and sort through several claims that have circulated around it. First, you will hear that the IRS is specifically targeting seniors. There is no evidence for that. The long-standing cash reporting rule applies across the board. The broader proposals were framed as tax gap enforcement tools, not age-based measures. Seniors care because the effect could touch them, not because the law singles them out by age. Second, you will hear that the $10,000 rule is brand new. It is not. It has been around since 1970. That is more than 50 years of history. If someone tells you the $10,000 reporting threshold suddenly appeared this year, they either do not know what they are talking about or they are trying to frighten you into clicking something. Third, you will hear that huge changes are about to hit overnight. That is also not how this typically works. Major reporting changes usually require congressional action, regulatory implementation, system changes at banks, compliance updates, guidance, and time. That does not mean the issue is unimportant. It means you should not confuse a policy conversation with a midnight switch being flipped tomorrow morning. Fourth, you will hear the opposite claim that because the earlier proposal failed, the issue is dead forever. That is too casual for my taste. Government interest in the tax gap has not gone away. The fiscal incentive to monitor underreported income has not gone away. The appetite for more data has not gone away. So while a specific proposal may fail, the pressure behind it can remain alive for years. That is the sort of thing intelligent investors and intelligent citizens pay attention to. Not because they enjoy worrying, because they understand persistence in incentives. Now let me tell you what I think matters most in practical terms, especially for retirees and families helping older relatives. The first thing is to stay calm. Fear is an expensive advisor. Fear causes people to do foolish things with money. Fear causes people to react to rumors instead of rules. Fear causes people to hide ordinary activity, split transactions in ways they should not, or start moving money without records. Because someone online told them the government is about to watch everything. That kind of panic creates more trouble than the policy conversation itself. So stay calm. The second thing is to understand your own financial footprint. Know what money is coming in. Know what money is going out. Know whether you regularly deal in cash. Know the difference between electronic deposits, IRA distributions, pension payments, cash withdrawals, and cash deposits. A person who understands how money moves through their own accounts is already ahead of most of the population. A person who does not understand their own patterns is vulnerable not only to government confusion, but to self-created confusion. The third thing is to keep good records. If money is legitimate, make it easy to prove that it is legitimate. If you make a large cash deposit because you sold a vehicle, keep the bill of sale. If you are helping settle an estate and money is moving between family members, keep documentation. If you are drawing from retirement accounts on a schedule, keep the statements organized. The world does not get simpler when rules become more data-driven. It rewards the people who can explain themselves clearly. The fourth thing is not to play games with thresholds. This is especially important. A surprising number of decent people think that staying under a number is automatically safer. Sometimes it is not safer at all. Sometimes it is precisely what creates suspicion. If you have a legitimate reason to move money, do it in a straightforward way and keep records. Trying to outsmart reporting systems is usually a poor hobby for people with ordinary finances. The fifth thing is to consult a capable tax professional or financial advisor if your situation is more complex than average, required minimum distributions, trusts, estate transfers, large cash holdings from a business sale, repeated family support, property transactions, caregiving arrangements, All of these can create patterns that are lawful but worth documenting properly. There is a huge difference between being fearful and being prepared. Prepared people do not guess. They organize. Now, I want to go one level deeper because the emotional core of this issue is not really about $10,000. It is about the relationship between citizens and financial privacy. For decades, Americans have accepted a certain bargain. Banks monitor some transactions. The government receives certain reports. In exchange, the financial system becomes harder for criminals to abuse. That bargain, whether you like it or not, has been with us for a long time. The argument begins when the scope of reporting seems to move from unusual cash events toward the normal daily life of ordinary accounts. That is the line that makes people uneasy. And frankly, I understand why. There is a meaningful difference between reporting an unusual $12,000 cash deposit and reporting that a retiree had more than some annual total of ordinary inflows and outflows. One is targeted at something conspicuous. The other edges closer to ordinary existence. That does not automatically make broader reporting wrong. But it does mean the public has every right to ask hard questions. What exactly is being reported? Who sees it? How is it used? What standards trigger further review? How long is it stored? What mistakes can be corrected and how easily? What protections exist for older people who do not have teams of lawyers and accountants? These are not anti-government questions. They are adult questions. A free society asks questions whenever visibility expands. That is part of the bargain too. I also think there is a larger lesson here about how people misunderstand risk. Most people imagine risk as something loud, a stock market crash, a bank failure, a medical emergency. But a great deal of risk enters life quietly through administrative systems most people never study. A box not checked, a form misunderstood, a threshold crossed, a pattern misread, a proposal reintroduced, a compliance burden shifted. That is one reason I have spent my life preferring simple structures and understandable obligations. Complexity always extracts a price from somebody, and when the price is extracted inside a large system, it is often extracted from the person least able to fight back efficiently. That is why I do not dismiss this topic. I also do not sensationalize it. I do not think that is useful. What is useful is understanding where we are right now. Right now, the existing $10,000 cash reporting rule remains in place. Right now, broader proposals have been discussed, but the most sweeping versions have not become law. Right now, the policy pressure to collect more information in the name of tax enforcement remains real. Right now, retirees and other ordinary account holders are justified in paying attention without assuming the sky is falling. That, to me, is the mature position, not complacency, not panic. Attention! If Congress revisits expanded bank reporting, there will be signals, there will be coverage, there will be advocacy groups talking about it, there will be industry pushback, there will be guidance. You do not need to spend every day staring at Washington with a magnifying glass. But you do need enough awareness to recognize when a quiet policy idea becomes a live one. This matters especially for people who say things like, I am retired, I have nothing complicated, nobody would care about my account. That may be emotionally reassuring, but it is not how systems work. Systems do not begin with whether you are interesting. They begin with whether you fit a rule. That is why clarity matters. Now let me give you the simple, practical takeaway I would want for my own family. Do not change honest behavior out of fear. Do not structure transactions. Do not guess at the rules. Do not confuse online alarm with actual law. Do know how your money moves. Do keep your records organized. Do ask questions before moving large sums of cash. Do get competent advice if your retirement income, estate transfers, or account activity are even moderately unusual. And do pay attention to public policy before it becomes personal inconvenience. That is the whole game in a lot of financial life. You cannot control every rule. You can control whether the rule surprises you. And that is often the difference between a manageable annoyance and an expensive mess. One final thought, the public conversation around taxes tends to get distorted because people make two mistakes at once. One group assumes any additional reporting is proof of tyranny. Another group assumes anyone worried about privacy must have something to hide. Both positions are childish. A serious citizen can support law enforcement and still care about overreach. A serious retiree can have clean finances and still dislike unnecessary visibility. A serious policymaker can care about the tax gap and still be required to justify how new data powers would affect millions of ordinary people. That is where the real debate belongs. not in slogans, in thresholds, in definitions, in implementation, in consequences, and in the lived reality of the people whose accounts would sit inside the system. So yes, this topic is worth your attention, not because it guarantees disaster, not because I want you nervous, because whenever government reporting rules, banking systems, and retirement income collide. I want you informed before the next proposal arrives, not after. That is how you stay on offense. That is how you protect your peace. And that is how you avoid becoming one more decent person who says, I wish someone had explained the rule to me before it mattered.